some comparisons between a couple of couple of listed names. Castrol India's dogged focus on retail has just started paying off dividend because the lubricant maker, which was lagging behind its listed peer Gulf Oil, has managed, at least for the last 5 years, has managed to turn the tables slightly in 2019. Shefali is here for more on the details. Shefali will get to what the second player, which is Gulf Oil, did over the last 5 years with Castrol as well. But first, the immediate thing, 2019 has shown a slightly different picture.
Well, yes, to some extent the auto industry slowdown has had a role to play in that. So why basically this difference has come in last 1 year? So it's important to look at the volume picture. I've taken last 6 to 7 quarters. So look at the volume growth for both these. For Gulf Oil, let's say in July to September 2018, it was doing something around 30% growth. Then in Q3 of FY19 as well, it was doing 34%. So from those 30% growth levels in volumes, it fell down to single digits in next 2 quarters, and from those single digits it came down to minus a negative growth in next 2 quarters. And for Castrol also there was a fall over last few quarters, but it wasn't much. So all the players were impacted because of the auto industry slowdown, but the fall in Gulf Oil was much steeper, and the reason for that was that Gulf Oil has a larger focus on the B2B space, that is the lubricants they manufacture which go to the factories, which they also term as factory fills. So that component is a little higher, whereas Castrol on the other hand is more retail focused. So you look at the breakup for Castrol, automotive segment is 90%, non-automotive is 10%, Gulf Oil is 60 and 40. So because of that higher 40% component, that component got impacted. Every quarter you speak to them, last 2-3 quarters they've said their factory fill volumes have been impacted because of the auto industry slowdown. So that because of that their overall volume picture has gone for a toss this time. So that is the picture over last 1.5 years.
Last 1.5 years. But if you look at the 5-year story, Shefali, it's completely different because the number 2 player has given the number 1 player a serious run for its money.
Yes, absolutely. In fact, it's a classic example of volume versus margin story. So Gulf Oil being the number 2, obviously they've had a lesser base effect of volumes. So they've grown at a faster pace. Whereas for Castrol, the focus has been very clear. They've focused on the margins. So let's do this comparison of volumes and margins. So for Gulf Oil, the average the volume growth over 2015 to 19 period has been 9.68%. Whereas for Castrol, it has been 3%. And if you look at the margins, Gulf Oil has maintained margins of around 18%. That's the average figure for last 5 years. And for Castrol, it's 28.6%. So Castrol has had very clear focus of maintaining the margins between 27 to 30%. And whereas for Gulf Oil, the focus has been very clear to grow the volumes and capture the market and increase the market share. So that because of that, the street was rewarding them. And even if you look at the stock price performance, the Gulf Oil over last 5 years has given much higher returns of around 55% over the last 5 years, whereas Castrol, which has degrown the share price by around 35%. And so that's what has happened between their volumes and margins focus. Going forward now, what are these companies saying? Gulf Oil is saying that they will continue to grow 3 to 4 times the industry, which they have been doing over actually not just last 5 years, but over last decade. So they continue to, they plan to continue doing that, whereas Castrol is saying that they will continue to focus on the retail segment, which they also call bazaar segment in their terminology. And also they see a revival in the auto segment going forward. That is a commentary coming in from Gulf Oil management that in next few quarters we will see a pickup. Even that factory fill segment will start looking up from here on. So they're optimistic about that, but they don't have any expansion plans right now because they're done with that largely, whereas Castrol is still planning to invest around 140 crores on the capacity, and they're looking to boost volumes. So that is important commentary from Castrol also coming in last few quarters, that going forward they plan to balance the two, volumes and margins. So it'll be interesting to see how it plays out, but the analyst fraternity clearly seems to be still favored in when it comes comes to Gulf Oil. So you look at the valuations, Gulf Oil is trading at FY21 PE of 14.96, Castrol about 16.76. So Gulf Oil still slightly cheaper in terms of absolute valuations. And if we look at the number of analysts tracking it, Castrol 11, Gulf Oil 9, and 82% analysts have a buy rating on Castrol and about 89% on Gulf Oil. Nobody has a sell rating on Gulf Oil, whereas 9% are still recommending a sell rating on Castrol, and 9% have a hold rating on Castrol, and about 11% have a hold rating on Gulf Oil. So slightly skewed in favor of Gulf Oil still.